This is one of those episodes that's going to make you sound really smart at a cocktail party because we're talking about something called a historic preservation easement, which again, if you're at a cocktail party, that's when like people are a little, they got to put on airs. They're a little smart, and this sounds like a smart thing, and it is a smart thing. It's also a really weird thing, and just something that I think is fascinating. This whole other world that I have recently learned about. And we're going to talk about that on the Furlo Capital Real Estate Podcast, where we dive into the intricacies of historic real estate investing. Yes. And our mission is to equip people to invest wisely in both properties and people so that together we can grow our wealth for our family tree history while improving housing. I'm James, and this is my wife, Jessie.
I just kind of want to know how many cocktail parties you go to. I mean, you just like, that was just like off the cuff. Like, the next time you're at a cocktail party.
That is a good question.
I was like, have I ever been to a cocktail party?
Sure.
I served drinks at a cocktail party when I was a waitress.
Well, I guess if you broaden it to a party where there are drinks being served.
Okay. A party of sorts.
A party of sorts, yes.
Or
know.
like
what's the
trivia night?
Pacific Northwest equivalent of a cocktail party? You're going to a barbecue?
Yeah, a barbecue?
If you're off to a barbecue.
I don't know. Cocktail party, maybe that's like more businessy? I mean, you could be.
That was like the next time we were at a networking event.
A networking event. A real estate networking club event.
When you're at a beer bash in the Biergarten.
Biergarten.
Let me think. Yeah, what's Pacific Northwest? What do we do here?
A wine walk?
A wine walk? A pub crawl?
Pub crawl.
The next time you're at a pub with friends?
Hey.
That's probably.
Okay,
the next time you're out on a pub with friends and at a pub.
The next time you want to seem super smart, use this episode.
Oh, man. Yeah.
That sounds like a
Cocktail
podcast
party.
in and of itself. That would be highly entertaining.
Yes.
Like they just talk about trivia and things you should know to look smarter at a cocktail party.
There's, what is it? Brian Brushwood. I think it's Ryan Brushwood. Whatever.
Brian Rushwood?
Nope.
Ryan Brushwood.
It's definitely Brushwood.
Okay.
They do like bar tricks.
Tricks?
Yeah, like that's
like flipping
a
a coaster thing or
all that kind of stuff. So here's magic tricks you can do, and their whole premise is you can bet someone, hey, I bet you $1 that I can order the next drink that I can XYZ, and then they have you do it, and then they show you how it's done. And,
that's funny.
Yeah. Huh. So yeah, they did a whole thing on that. I don't know if it's still going on, but yeah. So
there you go. Check
that out. Highly recommend it. No, this is when you're talking with other real estate investors and you go, hey, have you heard of the historic preservation easements? Or better yet, when someone is telling you about the fact that they're buying some really old building and that it's cool historically, I guess.
Sure.
That's where this thing comes in. And I learned about it not actually through one of my recent investments, the Baker Tower, which turns out is a historic building.
Yep.
But instead, it was on another project that had a whole bunch of historic buildings, and they were thinking about doing this particular strategy. And I was in the camp of I have never heard of this. I want to learn more.
There you go.
And so I did.
So you learned.
And I'm going to share so that the next time you are at a pub cocktail party, you'll sound really smart.
There you go.
Unlike how I'm sounding right now, talking about next time you're at a party that consumes drinks with fellow Homo sapiens. Yeah. So, all right. So we got to build this up a couple ways. So there's a thing called an easement. I don't know. Do you remember what an easement is?
It's just like you get permission to do something even though it's not your property, right? Like, I don't know. There was a water easement on one of the properties where it was like, yes, this
pretty
other
typical
property can use the source of water even though they're not living on this plot.
Right.
But they have access to it and permission
Correct.
to do it.
Yes. And it's different from, say, a lease in the sense that the thing goes with the land.
Right.
So even if it gets sold by someone else, it stays in place.
They keep the easement.
And this isn't always true, but it's typically forever, right?
Oh.
It's not tied to time.
Is
if
that
there's a well
specific to easements?
Yeah. It's one of those things if you have a well that's shared between two properties, it's kind of man, as long as this well exists.
Yeah. It's going to be shared by
now,
these
obviously,
properties.
the easement could disappear if the one who's sharing says, we're actually going to put our own well or we're going to do it, then they could get rid of the easement. When it comes to historic preservations, those easements do not go away. That's actually one of requirements is they last forever.
Who makes them?
Oh, dude, we're going to get into that. Lawyers make them. Yeah.
It's not like building owners.
Yeah. So what's interesting, okay, so that's an easement.
Mm-hmm.
Now, there's a historic aspect to this as well. You're essentially creating a historic easement. Oh, I think I'm trying to decide the right order in which to unfurl all of this. But yes, you give it away to some third party, right? Usually it's another owner, but not necessarily. Other easements are like mineral rights, or back in the day when they were doing a bunch of oil drilling, they'd be like, we think there's oil under your land. We want the rights to it, that kind of thing. And that's exactly how they talked.
We want the rights.
They did it. We want the rights. Give us the oil. See?
Or like roads. That seems like another one. Like if you can't access your property fully, you have to go over another one.
Yes.
You get an easement to drive through.
Yeah, like flag lots are often. Yeah. That's kind of the thing. Kind of. Yes. Yeah. No, 100%.
Yeah.
Yep. And you can have easements for all sorts of stuff. There's often utility easements, like hanging lines through a property is a thing.
So is the power line in our backyard and has an easement somewhere or something?
Yeah. It should. With Pacific Power, I'm guessing. Or
they're like, we can access your backyard because this is where it is posted or whatever.
I remember looking into it because it was just kind of normal. But yeah. But 100%. Yeah, because in theory, let me, if I remember correctly, you own from your dirt all the way down to the center of the earth.
Really?
Like a little triangle sliver. And then you own the air above. I think it's up to, what is it? I think it's like 400 feet or something like that. Might be 1,000.
So if we weren't part of an HOA that monitored like what we did to our house, we could like stick something on our house up that high.
Yeah.
Theoretically.
Yeah.
Put
a windmill up or something.
I would think like the city or the HOA would be like, nope, that's ugly.
Yeah. You obviously still got to follow city rules and stuff. And they may say like, you can't do that.
Yeah.
But, all right, cool. So in the case of a historic property, okay, what this usually means is that you're giving up the right to tear down or significantly alter the building in order to preserve its facade or key features.
Okay.
So an important aspect of it is it's all about the outside. It's all how it looks. Like you can change the inside to make it a bowling alley. They don't care.
Strange.
But like the outside needs to look like a historic whatever.
You would think that it would be maintain the whole building's purpose, as opposed to like it just has to look old or historical.
Correct. Yeah. Nope. It just has to look that way. So to qualify as historic, there are rules. So the building must be listed in the National Register of Historic Places.
How do you get on that?
Great question.
Be old?
So yes, number one, it has to be old, typically 50 plus years.
Okay.
And number two, it has to look as it did historically.
Oh, so if it's already been altered, you can't add it to the list.
Now I have a hunch there's like, you can work around that where if you restore it back to its old look, you might then be able to potentially
apply to add it.
And here's the hard one. It's associated with an important event or activity.
Oh. Like what are some examples of that?
If there was a war that took place, if there was a famous person who lived there.
Or if there was like some historical fire or something that survived.
Yeah, and it doesn't have to be like nationally well known. It could be locally well known. Yeah.
Or like there was like with Baker Tower, there's some association of like it existed with the Oregon Trail or it was like
whatever. Yeah.
It had significance.
Yeah. Now oftentimes you can also have what are called historic districts.
Okay.
Which technically the Baker Tower is in a historic district. The building itself isn't historic, but it's within a historic district. And so you can kind of use that as it's within the district's been considered historic and it qualifies in the fact that it's old and it looks the way that it did.
Interesting.
Kind of back into it. Like for the Baker Tower, that's one where I'm like, the picture that's on the historic registry is of the Baker Tower. So I'm like, all right, I feel pretty good.
It's a pretty iconic building.
Yeah. Yeah. Well, I go into the tax treatment piece. I'm going to have you take care of our crazy dog who is doing whatever he can to get our attention because he's like a little kid and that's what he does. So that's how easements work, right? So the idea is, or a historic easement, I should say. The idea is you are saying, hey, this is a historic building and we are making a commitment to never change it again, right? Like this is for the life of it. And you are giving that easement to somebody else. Now, here's the tricky part. It's not just anybody. You want to give the easement rights. So it needs to be to a qualified nonprofit or government agency.
Oh.
So I know this is so we're getting into it. So essentially we'll use Baker Tower as an example. I would then give an easement of the facade, not the inside, just the outside, to another nonprofit saying, you guys are now in charge of making sure that it stays the same.
Okay.
Now I still have to maintain it because I still own it, but they're the ones who
enforce that it
essentially
looks historical.
Yes.
Weird.
Okay.
So you have to create an easement and somebody else has to manage it. Can you manage it yourself?
Can I be the owner of the nonprofit?
Yeah.
I don't know. My guess is no, but
that's
I don't
also
know.
my guess, but
I don't know. I didn't get that
it's
far.
a little strange.
For the situation I was looking at, I didn't need to.
Sure.
There are, shocker, third-party nonprofits that this is what they do.
Yeah.
Because they get it.
Yeah, their historical preservation is a thing.
And I can hear you saying cool, James, so what? All right. Here's there's money involved.
So we want to
That's
keep
why.
buildings
All right.
looking old.
So the IRS treats easement donations as charitable contributions. That's why it's important that you give it to a nonprofit. So the deduction that you get is based on the difference between the property's fair market value before and after the easement. Okay? So
Weird.
it's because in theory, with this easement now in place saying you can never change the building, the value of the resale of the property drops. Right? So let's
Wouldn't
say
it go up because you're buying something historical
so
as value?
let's say hypothetically our house. Okay. Single family home, middle of nowhere, wouldn't qualify.
Sure.
But let's just say hypothetically we're doing this thing.
Yeah.
From now on, it will be a green house, a pink.
Oh, it
blue
has to
green
be
house.
maintained.
The garage door will stay wooden. The windows, if they were whatever, will stay how they are. I can already see you so you know how we added solar panels?
Yeah.
Nope. Can't do that.
Okay. So I could see how that's not.
Or let's say in the
It
future we
lowers
were
the value.
hey, let's tear this down and build a duplex.
Right. They'd
Nope.
be like, nope.
Can't do that. That's the
Okay. So it
preservative,
lowers the value.
right? And so the difference between those two is considered a charitable contribution.
How much are we talking about? The value being lowered?
It depends on what it is, right? So it's think about the Baker Tower, another example. So I bought it for 1.65. So it's clearly what the market value is. And I would make the argument that that's after this, because it's in a historic district. That's the post preservation value. But let's just say it wasn't in a historic district and they were yeah, you could tear it down and build whatever you wanted.
Interesting.
I mean,
It could be worth a lot more.
now it's as is selling to someone else to develop, right? So it's not saying,
Sure.
oh, what if I tore it down and built an 80-unit apartment building? What would the value of that be? No.
Right.
It's what would the value be to a developer who wanted to buy it to build
Sure.
an 80-unit apartment building?
Yeah. So essentially it just limits future plans for the building. And so
Yes. So the
your
trick,
market for who you're going to sell it to shrinks.
yeah. So the trick is that a qualified appraiser determines that value.
Interesting.
Now, in my case, half of it's already figured out, but you'd have to figure out both. And the IRS, they really scrutinize this because, shocker, what it could be, someone would obviously pay $10 million for this.
Right. It's
Right. So you need to be able to have bulletproof, defensible, no questions asked. Everyone goes, yep, that's reasonable.
Interesting.
Yes. And my guess is, I don't know how an appraiser does it. Maybe you get 2 or 3 and you take the average, or you go, hey, we'll go with what the lowest is, something like that. If you could get someone to make an offer as if, that would help. But again, how do you not have collusion in there and stuff?
Right.
And which for Baker Tower's case, it's already you can't hide that. But if you were we're going to do this, and so you put it on the market as if for a developer, and then you get your offer in, you go, awesome, cool, that's our number. Now we're going to add this easement to it. Now it would be worth So yeah, that's the tricky part. But like for obvious reasons, this is like, what could it be is like, you got to get that right.
Yeah.
Because you can get in a lot of trouble if you do it wrong. So let's say that you have an unrestricted value of $1 million and a restricted value of $700,000. Okay. So then the donation value is
$300,000.
perfect. Now, normally charitable deductions for appreciated property are capped at 30% of your adjusted gross income. Okay. But so what that means is, say, in this case, your $300,000 thing, depending on your income, let's just say, I don't know, you only made $100,000 a year. You could only deduct up to $30,000 because that would be your 30% cap. But for historic easements, they allow up to 50% and a 15-year carry forward. So again, if you made $100,000, you could actually deduct $50,000, and then that remaining 250, you could then
50 each
you
year.
could do over the next 5 years.
Wow.
Up to 15 years.
That's significant.
Exactly. Exactly. So, you know, and in this example I'm giving here, right, it's not necessarily like magical, oh my gosh, but like it could be very valuable.
Okay, so just to make sure I'm understanding this.
Yeah. This is actually my next section. But
qualifies for that deduction?
The owner of the building.
So it's the owner who allows the easement.
The person who grants the easement.
Okay.
Got
it.
All right.
Because essentially they're losing money.
Yeah,
kind of.
essentially. Yeah. Yes. And they're more importantly giving it to
a
this
nonprofit.
You can't just say, hey, we're a historic building now. The value of my building's dropped, so it's going to be a write-off. Like, that's not a thing.
No,
it's got to be this charitable donation piece to it. Yes. There's other stuff. Yes, we're not going to get into the weeds about it. But, okay. You ready for it to get, like, that and alone, you're like, oh, that's cool. Sure. That could be worth it. Just that, like I said, that alone, thinking about Baker Tower, I'm like, it's probably worth talking to a lawyer company. Yeah. And you could see where they get in there and they say, hey, we'll be that nonprofit and we will only charge you $20,000 to do all the paperwork for you. You know what I mean? And you go, yeah, worth it. You know, assuming you can get that value to be what it needs to be. All right. You ready for us to level up in the complexity and awesomeness? So you can do what's called a syndicated conservation easement.
What?
Oh, I know.
So crazy.
It's controversial, but essentially you form an LLC, just like a normal syndication. And this thing totally cut off on its printing, so that's exciting. Okay, I think I got it. You create one. In my case, like we created an LLC for the Baker Tower. Yeah. Check, already done. And then what happens is, you could, how do I want to describe this? You then sell the company or you sell the building, the full building to this LLC. Okay. Which you may be an owner of it. Someone else may be an owner.
So the LLC didn't buy the building initially.
Correct. Now I've already done this step of it, right? Like I formed an LLC and the LLC is the thing that bought the building. Yeah. Which is cool. And we raised $550,000 to buy this $1.65 million building. Cool. Got leverage. It's awesome. Investors contribute capital to fund the purchase, just like normal. And you set it up where you could still retain control over the property, just like normal. Sure. Okay. Like in my situation, my investors, they own 80%. I own 20%. But I also it's a different class of shares. And so I manage the entire thing. As a matter of fact, to protect them legally, they are not allowed to do any management stuff or protect them financially. They're not allowed to do any work. Okay. So now you get the appraisal on the property, right? Figures out what the highest and best use could be. What would someone be willing to pay in order to develop and do that highest and best use? So let's say in this case, the unrestricted use could be like, say, worth $5 million. Oh. And the restricted use is only $1 million. Okay. Okay. So that LLC that owns it donates the easement to a land trust, to this nonprofit. And that $4 million, right, that becomes the charitable donation. And it's the investors that get the deduction. Oh.
So it's multiple owners. Is it split evenly, or does it have to do with how much they gave?
It's however you design your waterfall. Okay. Yeah. Whatever the split is that you would normally split the profits, they get this. So here's this example, okay? So let's say in this example, investors they buy the building for, I'm trying to keep the math really simple. You buy a building for $1 million, or they invest $1 million into buying this building. Unrestricted, it would have been worth 5. Restricted, it's only worth $1 million, which is what they happen to put in for it, right? So now in this case, right, the investors get to deduct
$4 million
from it. So let this sink in for a little bit. You invested $1 million, you get to deduct $4 million. That's a 4x whatever
value
increase over it. Now, they introduced some caps into this because people were like getting crazy about it, but it's kind of nuts. So then on your taxes, you then get to write off that $4 million, 50% of your AGI over the next 15 years. And it's borderline like you actually make money on the deal. Right? If you think about what your tax bracket is, and we're talking about high income earners, they're at a higher tax bracket. Like if you take that $4 million in terms of like true savings, you multiply it times, whatever percent bracket they're at, like the 35%, like they actually walk away making money on the deal, which is what used to happen. So companies would set these things up where they would say, hey, we saw your building. We think it could be historic and awesome, which is great. We recommend that you do this thing. And then they just pull from investors from around the world who they invest. And because of the super high caps and the values and stuff, they end up making money on their taxes, which is insane. Now you never actually get the cash, but your tax savings are so dramatic. It's, it's as if you made, mathematically you made money. You just don't necessarily get the cash in your hand. Now, the advantage of, say, like an organization, like, again, if it was our house and someone came to us and said, we want to do this, we would be essentially selling the property to that other company, and we would get the cash for it. And you could still retain a controlling interest in all of it. Like, because maybe you only, whatever. And so now you've got cash to play with.
Super big, weird loophole to not pay taxes.
Yeah, but it's an awesome one. Yeah, no, it is definitely weird.
Yeah.
But the idea is, so let me try to land this plane here. So if you've got an older building that has potentially some sort of historic significance to it, and I happen to have one, which is instantly I was like, I need to learn more about how this works. And so if you have that, and I, like I said, I've already syndicated it. I've already raised the funds for it. So in my particular case, we could throw out some numbers, and I don't have a calculator, so we'll have to figure it out. But my investors invested $550,000. At the restricted rate, it was worth 1.65. Let's just say, hypothetically, that if it were unrestricted and they could do whatever on it, the building would have actually been worth, like, I don't know, I'm trying to keep it, let's say 1.85.
Sure.
So $200,000 more. Whatever. So in my case, I'm like, we should totally do this because then we can do the charitable donation of that extra $200,000, and I can walk to my investors and say, hey, great guys, good news. You guys get this $200,000 deduction. We get 80% of it, I guess. I get the other 20%. And they just get to deduct that from their taxes for probably some complicated paperwork, but it's all about, can we get that justified, the unrestricted rate, which I already know. So we bought it for 1.65, but the appraisal actually came in at 1.8. So I'm already like, dude, we already got 150,000 locked in. Now we just got to make the case like, actually, if this was unrestricted and we could build anything, this would be worth more. Now, that actually may backfire on me because my building actually is iconic, and that alone has brand value to it.
Right.
So it might actually work against me to say, well, if you destroyed it, it wouldn't be worth as much. Outside of saying, well, how big of a place would I be allowed to buy? And then you could work backwards on saying, okay, the market cap on something like that. Let's say, oh, we could put in, maybe they wouldn't let me do 10 stories anymore. I get capped at like 5 stories, but I could do the entire thing, and I could add, let's say 50 units to essentially double the unit size. I could easily make the argument to saying like, well, yeah, the cap rate, if the cap rate's all exactly the same and we just increase your revenue because we doubled the size, your buildings now were 3.6. Like I could easily, like that to me, I feel like that's justifiable.
Yeah.
And that's the math. And then I go to my investors and go, good news, guys, we're never paying a penny of taxes for this building over the next 15 years.
So that made me think of like the appraiser in this scenario. Are there specific appraisers to these historic easement types of things? Because it's like they would have to understand some of those nuances of like
I would
the
not
value of the historical
There's gotta
building
be.
versus brand new, and how do you even compare those or put a
Probably.
value to them? Yeah.
I don't know.
Huh. Weird.
They have to be a qualified appraiser. Now, I don't
Sure.
know if that
Oh,
is
if that's
like
just an appraiser in general.
a general one.
Or if they're
but
historical
I
easement.
I have a hunch there's a historical easement appraiser designation
Interesting.
that they get.
Yeah.
And I have a hunch whoever you work with to do this goes, here's who you want to call.
That makes sense to me.
Because
it's very specific.
Yeah. I don't think a normal appraiser would get that whole highest and best use idea.
Sure.
Which again, it's what would someone pay for a building if it could be its highest and best use? If you could somehow
that's weird.
change the outside and redevelop it and either do like a full-on redevelopment or, we're just going to maximize, we're going to change the outside of this. We're going to update it somehow. We're going to repaint our house to a better color.
Sure.
Right. Whatever. Yeah. So anyways, super cool. Really interesting. It just, to me, it just goes to show there's so many like niches and nuances with real estate that like, that wasn't even on my radar. I mean, like I literally was buying something that is like pre-packaged to do this. And I had no idea.
Yeah.
Until I was working on another project and they started talking about it. And I went, whoa, hold on a second.
Out.
Time's up. I want to learn more about this. Yeah. So just super fascinating. That's something that's on the list to
All right.
figure out how to do because it sounds cool.
Does sound cool.
Yeah. Anyways, hopefully you found that interesting and you're like, dude, I'm going to sound so smart at my next pub cocktail party event with persons of interest. Oh, you will be that person of interest for sure. Oh my gosh. So you're welcome. Yeah. So with that, thanks for listening. Have a great day.